This one has to go this way. What's up, everybody, and good afternoon. J-Do coming to you from the studio where we talk the save and spend system. It's the Cash Compound, and this Thursday afternoon, 3:30 Eastern Time, we are back for another hour of Ask Me Anything. What's up, everybody on TikTok as well? YouTube family, anybody on Zoom, and our TikTok family and audience out there. Shout out where you are TikToking in from, and if you're on the YouTubes, do the same thing in the comments. Go ahead and put comments, concerns, and questions in the chat as we talk through the save and spend system. Let's go. We've got the 3-cup setup here on the table, and I'm in Greenville, South Carolina. From our offices, we teach people how to save and spend money at the exact same time. You can put a heart or like on the screen, double tap right there in the middle if you love to learn about how to keep the money that you make. That's where we're walking and talking through here today. And the 3-cup setup is where we put our dollars so we know where we are getting the most value from the things that we earn. If you learn about the money that you earn, you'll be able to keep it safe and constant compounding for the rest of your whole life. What's up, everybody? Appreciate you joining out there on our Cash Compound TikTok page. On that profile and page, you have lots of resources if you click the link in the bio. I think if I'm pointing right here, you can get to that link, the Cash Compound. So follow us. What's up, Goddess? Let us know where you're TikToking in from. We're in the northwest corner of South Carolina, Greenville. And that's where we live, work, and play, and all the money we earn today is going in here right away. Inside cup number 1, the premium deposit cup, that represents the dollars we give to the insurance company, and it buys us insurance of all crazy things. The reason we want insurance is because that's the only thing we can buy where we have a guaranteed pool of money that we purchased. If you give your money to an insurance company, you do realize that you've bought yourself a pool of their cash. A pool, a peace of mind, pamphlets, paperwork, a payout, it's all coming to you. And because it's whole life insurance, it's guaranteed to do so. These dollars, the dollars you put in purchase, just a couple of them bought all of this money from the insurance company. And whole life insurance has to have a claim one day because you and I have to die. These dollars are guaranteed to pay out. It might be tomorrow, it might be when you're 105, but it's whole life, so they are guaranteed to pay. The insurance company knows that up front. You got it? Is that making sense? Put a couple hearts and likes on the screen and share this information. If you click right here, I think you can share this page with some friends, families out there. Speaking of your friends and family, they become your beneficiaries, right? It's not you who's going to get these dollars from the insurance company, but it's going to pay to them. Friends, family, church, and charities. Because it's guaranteed to pay. That's what cup number 2 is all about. Cup number 2, the green one, is cash value. It's how much equity we have in the total. It's how much borrowing and leveraging and liquid power we have in the payout that the insurance company owes to us. Okay? Why can't you live forever, Ian says. Well, nobody's been able to figure it out yet. So the insurance company already knows there's a 100% probability that you die. It's a guarantee. And because you have a guaranteed payout, these dollars are going to come for sure. Cash value is how much we can leverage so far from our policy and borrow from the insurance company and leverage against the dollars that we have growing and cash flowing for us without ever losing the power of our money. Put your dollars to work. If you put one in here, it has to buy these over here. And these cash value dollars are ready for you to be using. What if you could save your money and spend someone else's on cars? Or save your money and spend someone else's on your home? Save your money, spend someone else's on debt. You see what's happening here? So we're taking questions out there, and if you want to know more in a one-on-one private conversation, you can do so by clicking the Cash Compound. Follow, go to our regular TikTok profile, click the link in the bio. There's only one link to rule them all, and you can have a free cash consultation with one of our coaches. We walk and talk people through how they can become their own banker. That's what it's all about here. And Art Nelson Nash created a book and a concept. Infinite banking is that concept. And the infinite banking concept teaches you how to become your own banker utilizing guaranteed, permanent, growing, cash flowing, income tax-free pools of money from your whole life insurance from a mutual company. Got it? Hey, Joker, appreciate you out there. Shout out to everybody wherever you are and on this channel. Remember, you can follow us. We got YTIG, ABC, TT. We got all the social platforms that you want. And if you follow us on those platforms, let's go. Dollar bills, y'all. You can get into the conversation with us on all those platforms, walking and talking through the save and spend system. That's what we call it. It's when you're utilizing and leveraging whole life insurance. When you pay those premiums, you get money that was not yours previously. We're borrowing against those dollars while our dollars are still compounding and growing and earning dividends. That's why we use mutual companies for this process. What's up, North Carolina? Joker, let me know what city or town are you in? Greenville, South Carolina over here, so right off of 85, heading into town, going toward Atlanta, or wherever you like to go in our state. Fairmont, what's good? I don't know Fairmont out there. What's the big city it's closest to? The big city. Fairmont might be big. What are you doing? What up? We're teaching and preaching cash value use from your infinite banking whole life insurance policy system. If you have whole life insurance from a mutual company and it's built for cash value, we're going to have lots of money to use, lose, or abuse even. Oh, Lumberton, let's go. Not a big place at all. I know Lumberton. Okay. And we are going to leverage that for all of our purchases. That's what we teach and preach here on our profile. So give me a heart and like out here. Ernesto, what's good? I'm going to switch over to my YouTube family here in a second, and let's get some comments in from them. But if you're out there on TikTok, don't go away, don't go far. Go ahead and give us some questions, comments, and concerns. Hey, everyone, welcome to the stream. That's us. Can you discuss difference between HELOC versus whole life? Sure. Well, whole life works like this. Your HELOC can work a couple different ways. Whole life works like this. I'm assuming that's the one that you know less about. Let me know, Ernesto. Appreciate you chipping in from our YouTube community. So you can go ahead and click that subscribe and the like button over there. Okay, remember our whole life insurance, when we borrow against it, we don't need permission. Number one, we have control. Number one, your HELOC can be taken away, can be stunted, can be called back from the owner of your debt or mortgage, and that is the bank or the finance company that gave you money for your house. Whole life insurance is something you own and control, so you can leverage it like you want. Okay, so that's number one. Number two, remember that borrowing power from your HELOC or whole life isn't the only feature for whole life. So when we give our dollars in premium to a whole life insurance company carrier for our policy, it buys us death benefit. Your HELOC doesn't have this cup at all. So when you die, not if, when you die one day, you always are going to get paid out. Your family, friends, church, and charities will receive the big blue cup, the death benefit. We're borrowing against the money that the insurance company owes us, and there is no piece of that in our HELOC. You with me? Those are two things so far. Say two if you're still with me, Ernesto. You guys still with me out there? Stay with me if you are getting it. Okay, number three, when we borrow against our policy is still going to grow. Very important to understand that. When we borrow cash value dollars from our life insurance policy against our life insurance policy, it becomes collateral for our loan. And now we're able to leverage these dollars without stopping the constant compounding of our money. You with me so far? Ernesto, how am I doing? Remember, there's nothing wrong with your HELOC. I'm not mad at it at all. Your HELOC is often interest only. I don't know. Your HELOC often has does your HELOC, do you already have a HELOC? Say yes or no. If you're out there on TikTok, let me know. Do you already have a HELOC? Have you borrowed against it? There's nothing wrong with a HELOC out there. They all have different terms and things. I'm not super familiar with all the breadth of options in the average family's HELOC. However, good. You understanding? Cool. When you borrow against that, my brother's on the phone there. He's the other one of us who is a banking bro. He and I call ourselves the banking bros, and here at the Cash Compound, we teach people the save and spend system. He's on the call. I don't know what he was saying, but I think he wanted to leverage his HELOC, so he got himself one, about to borrow money if he didn't already. I think he may have borrowed some, and lend it out to other people. So he's going to make money from lending against his home and the value there. Lots of people understand that. Some people have even done it, but do you realize we're able to do it from a policy we control that keeps compounding? It's income tax free and will provide death benefit for our family. Ernesto, if I have not said enough, ask me more questions and get more specific, but hopefully you understood where I'm coming from and definitely where I'm going and why I choose to pay myself first in whole life insurance, leverage against it when and if necessary for all sorts of purchases, and potentially do that and continue utilizing my HELOC for a similar banking function. Just remember that all of the pieces of the pie in whole life insurance don't necessarily qualify or represent your HELOC because you don't control it, there's no death benefit, and there may be terms on it you don't have on your life insurance. Let's go, ladies and gents. It's J-Do here coming to you Thursday afternoon. You can click in to join us on our Zoom call. If you're watching on YouTube, we can switch to it soon, but on our Zooms and on YouTubes, we often have visuals that you can follow along with. So appreciate you following out there on TikTok. Click the Cash Compound link in bio and go watch our regular TikToks. And those posts and those videos will help you understand piece by piece how you can become your own banker. Sound good? Ernesto, appreciate you, baby. Do you already have a policy? Are you working with us already? Do you need a one-on-one consult? How long you been following? Give me some more feedback out there. I'm glad that you enjoyed my explanation. It's probably not everything you need to know about HELOCs, but it helps you understand the features and the functionality of utilizing your policy. Okay, what other questions do you have? Questions, comments, and concerns can go in the chat. If you love, like, or learn something, I want you to click this heart. Give us a heart, give us a like. Here to help, here to help. I'll tell you a little bit more about myself. 9 years ago, I started my first infinite banking policy. My first life insurance contract that was guaranteed to allow me to leverage those dollars, borrow against that big pool that I purchased or death benefit for financing needs. So I don't lose money that I normally used to use by paying interest to third parties by way of debts, or two, losing interest I would be able to earn by paying cash. Now I place my cash in the stash in Cup 1, which buys and supplies me a bunch of dollars here in cash value. So I can use, lose, and abuse these dollars in cash value now without ever losing the earning power and the growth potential with all the safety and liquidity of my whole life insurance. You got it? Good. All right, we have got Coach Rob joining us here. And we've got a small but mighty folks team of folks here who are watching on YouTube, as well as our Cash Compound channel on TikTok. So we appreciate each and every one of you who comes and stops by and asks us questions on these Thursday afternoons, AMAs. And when you have more questions, throw them in the chat. We're here to help. If you want to join our community, we do have a Facebook group. We'd love for you to jump in there. It's called Infinite Bankers. You can find the links in our registration areas and our links and bio areas and all that stuff, and you can join us there. Ernesto has one more, just starting following recently. Family told me to tune in. What's up? Your family told you specifically to tune into us. We love it. Do we know them? Actually, that last name of yours looks semi-familiar, so maybe we do know your family friends out there.
You got a good family. My mom just sends me a bunch of random TikToks and stuff.
My mom does that as well, but my mother has a tendency to binge watch her TikToks, and I believe last night was one of those nights as well. So I got about 10 notifications, you know,
That's how
pop,
she does
pop,
her.
pop,
So
pop,
boom,
pop,
boom,
pop.
boom, boom. I'm like, well,
Yep.
what are you doing? What are you doing? It's not what this is for.
But my mom does send me a lot of gospel church style memes from time to time. She sends those memes on Instagram mostly. on Instagram.
That's the worst place to get it from. Yeah.
It doesn't bother me much. I'm glad she's tuning in. So Rob is going to, for those of you who are on YouTube out there, and if you end up ever registering for our Thursday afternoon AMAs, we might have to check in with Will with that.
Yeah, let's see about that pin.
We have visuals for you. So those visuals are going to be on our Zoom if you register there, or on our YouTube channel streams as well. So we're hoping that we can draw some things out for you, and I'm going to turn things over to Robert here to continue answering questions and teaching. Let's see if it works there.
Great. Let's take a look and see. Well, let me see if I tap here.
I don't know how to do it either.
Yeah, it's just my first time here doing.
Try now. Nope. Does anybody know how to work this? We need you guys to help us out.
Jonah's the only person who gets it right, I guess. Okay.
Well, you can draw on it.
Well, we always got the classic 3-cup setup. Here, if this doesn't
we got it right here.
Start working out for us in just a minute, we're going to use.
Sorry, I missed that one. Ernesto says late to the game, but preparing to catch up. Hey, man, you're here, and that's what's most important. Moving forward from this point on, we need to know where we can save our money, where it's guaranteed to grow in cash flow for us. That's what's important. So it doesn't matter when you start.
Swap them out.
Now that you know, we're going to get started whenever you're ready.
Swap these bad boys out.
All right. Appreciate you, Ernesto. We'll be talking soon. Did you already connect to the...
I was just about to say that. Do we need to connect this?
Oh, okay. Don't worry about it. Nobody's on the Zoom.
Cool beans. Let's,
there you go.
Let's go from there. Oh, yeah. That's nice.
There we go. Okay, Robert, I'm going to turn things over to you for a few minutes. Let me get up from my spot. Appreciate you guys out here on TikTok watching along. And let's turn things over to Robert and get a good angle on him.
All right. The only problem I have now, you want me to come over a little bit? Or? So, yeah, the only issue we have now is finding the eraser. There we go.
You draw upside down?
Can I draw upside down?
That's how the people on TikTok are going to see it.
Oh, yeah, that makes good sense now. Yeah. So, guys, I wanted to go over and talk today about what you could do if you're trying to finance a purchase. And if you have a policy, let's say, and you choose to put in a certain amount of money into it, and the purchase that you're trying to, you're trying to make this purchase, but this purchase doesn't necessarily meet the budget of the cash value that you have available, right? So let's say, for an example, I do a policy for $1,000 a month, and that's $12,000 a year. And what it is that I want to purchase, it could be $25,000, whatever it is. Instead of you trying to build up the cash value inside of your policy, which would take a longer amount of time. So if you're on TikTok or you're out there on the YouTube, instead of you trying to take that approach to it, what you could do rather is you could actually break that down into regular financing payments the way we always do, right? You go to the bank, you get a loan. And this is a big misconception. Because you are your own bank does not mean that you still can't leverage the traditional banking system. We still have, and let me make sure you can hear me pretty good here, we still have regular checking accounts. All we're saying is we don't store our wealth inside of a traditional banking system. It doesn't make sense for me to have hundreds of thousands of dollars or even just thousands of dollars inside of a bank account that doesn't earn interest when I can put it inside of my own banking system that actually earns interest, and it gives me the ability to collateralize. So I can save money here in premiums, right, while still being able to spend money from cash value. And just to recap, where is the cash value coming from? So let's understand 3-cup setup before we try to dive all into everything else. So right here we have the death benefit cup, we have the cash value cup, and the premium deposit cup. All right. So hopefully you guys can see this inside of a proper way. I make a premium deposit, right? It buys me a death benefit. That's what any type of insurance does. It buys you coverage on something. So whether it's your life, your boat, your house, or whatever, you see the insurance commercials all the time. I don't have to go over that with you. So here, the coverage is going to be on our life because it's a whole life policy, and it covers us for our whole entire life. Unless you found out something that I don't know, you found the fountain of youth, you're going to pass away at some point in time, right? So if it covers you for your whole entire life, that is a guaranteed thing that's going to happen. You're going to pass away at some point in time. It's not guaranteed that you'll crash a car. It's not guaranteed that your house catches on fire or a flood or something like that, right? So from there, because you have guaranteed collateral, what is the insurance company going to do? They're going to say, hey, if your policy set up the right way, you come and we heard you got a policy with the banking bros. They helped you out, set you up for infinite banking policy, right? Which is a whole life policy designed for banking. You're gonna have immediate cash value that you can use. So you don't have to wait like traditional whole life. You hear it all the time. Oh, I gotta wait 3 to 5 years, and I don't really have that much cash value, and so on and so forth. That's because of how the policy was designed. We're going to be able to take a loan against the collateral here being our death benefit. So our death benefit is guaranteed to pay. It's a larger sum of money that has to go to our family when we die. We're going to be able to loan against that right now when we're alive. Now, this is where a lot of people get confused. Well, I'm taking a loan and I got to pay some interest on it and so on and so forth. Understand this. You're not dead. Dead people need death benefits, not people that are alive. So let's say, for an example, the cash value that I have and I want to use out of this policy is not enough to get whatever purchase that I want to get. What I could do instead, and I'm going to actually use a credit card example of paying off debt, all right? So what I could do instead is I could minimize whatever it is I'm trying to pay for to where it can fit within the budget of my cash value that's coming out of my policy. So in this example, I'm going to start right now. And hopefully this isn't too messy or anything. I am putting in $1,000 a year, so that's going to be $12,000 annually. Okay, not the best handwriting here. First time using the pen. Okay, so don't judge me too much here. Let's see if we can get this set up. So I'm going to be putting in. I'm going to put in $1,000 a month, which is $12,000 a year. Okay. Bad handwriting here. Let's see if we can erase that and make it a little bit better. It's harder to write with this thing than you think. All right, so I'm going to put in $1,000 a year. And let's say I have some credit card debt. Okay, and this can and keep in mind this can apply to a number of different purchases. It could be a car purchase or whatever, but I'm going to start with debt because a lot of people have debt. It's something that we can all be familiar with, right? So I'm going to put in $12,000 a year. Annually, okay? Horrible handwriting, bear with me. All right, $12,000 a year. What that's gonna what's gonna produce me? Let's say it produces me $8,000 in cash value. So I paid that inside of premium. I'm happy you're back. You might catch me on some slip ups here. Okay,
I'm with you, no problem.
Okay, let's say we have $8,000 in cash value that we can use. Okay. Now let's start, and I think this would be a good example. We can probably start with let's start with a vehicle. That'll be all right. So let's say what's a average car note?
These days, I would assume that probably a little higher than that. I think it's probably more like 700 if I had to guess.
700, a little bit. So, yeah,
600, 700.
$50,000 car.
650. We can go in the middle.
650. Cool. 650 times that out by 12. What's that, about $8,000 a year?
Yep.
Yep. Right on the head. $8,000 a year. So if I try to go buy this car and the car note itself can be $650 a month, well, I have $8,000 inside of my first year in cash value. Now that I've broken up that total payment, that total purchase of, let's say, $40,000, $50,000, I've broken it down into an actual car note. So let's go ahead and put that on there. It's harder to write with this thing than you think it is.
I believe that. All right, $650 a month, right? Which is perfect. Matches up to your $8,000 in cash value. Yep.
Now, can my policy afford it?
As it stands, yes. If we've got $8,000 in here, I'm not sure exactly. I came in a little late if we're financing it monthly or all at once. But
well, we're doing Remember, we can do $12,000. We're doing $1,000 a month.
Okay.
Right, but it's $12,000 annually. Okay.
Yep.
So same thing here, and just I guess what we can do is we kind of give them a little bit more information on how it works when you're being your own bank. If I put in $1,000 a month, I like to say that I tell people this on the phones: how you pay is how you play.
I like that.
So if you put in monthly, you can take monthly loans. If you put in quarterly, You can take quarterly loans, but the whole thing is, if I put in $12,000 one time, I'm going to have my whole entire $8,000 available to me at one time.
Right.
If I put in $1,000 a month, they're going to take my $8,000 and divide it by 12, which comes out to what?
About $650.
About $650 a month.
So we do have the funds then to finance a $650 note based on these numbers generally. Yeah.
Correct.
Mm-hmm.
So what we can do is we could use the cash value to then, oh, wow, that's bad. We could use the cash value to then pay the car note. Right? Cash value pays the car note. And now, because we use the cash value to pay the car note, we're paying the bank back, the money that we took, right? But more importantly, now we have an opportunity to pay ourselves back and recapture all the money that we paid for this car, plus the interest that we paid to a third-party bank, right?
Mm-hmm.
So now I can make repayments to my policy. Here's the thing: is inside of year 2, are we going to have the same amount of cash value, or does it go up?
Cash value compounds for us on an annual basis. So every year we should be expecting more guaranteed cash value numbers.
Okay. So because it's going up, doesn't that mean, but my car note is going to be the same, right?
I hope it's not going up.
Yeah, it's going to be right, 650, right? So with the increase in cash value, but my car note being the same, I can apply even more. So let's say next year, just hypothetically, everybody's number is going to be different. We got different health, different ages, so on and so forth. But let's just say hypothetically, my cash value increased to $15,000.
15.
From 8 to 15.
That's quite a jump.
Think so?
I do think so.
What you want? You want to make it more?
Yeah, I thought if we're going from year to year, I would expect there to be about $8,000 in year 1, and if we're not talking about our loan repayment interest making the cash value bigger, I would expect with
no loan repayments.
Right, with no loan repayments, I might expect $9,000 in cash value or $10,000 in new cash value. Okay, 10 is a round number, and that's probable, likely.
Oh, I'm messing stuff up here. How do you do this? I tell you, we need a class on this.
I bet we do, but you won't be learning it from me. Yeah, I'm not sure.
Yeah, we gonna do it on the go here. Yeah, so now it's super small. I'm not sure what I did there. Oh, okay, I got it. All right.
We're still here with you, ladies and gents. We're gonna flip this around. Appreciate you guys. Remember, you can follow us on our channel at the Cash Compound right there. Click right there and join. Better. And we will continue helping you learn. All right, Robert, where we leave off.
All right, so cool. We were messing up on here. But with that being said, what do we have now? So we have an increase inside of our cash value, but our actual car note stayed the same. So over time, we're going to be able to pay this off faster. Now, I don't want to go too much into it. The handwriting's horrible. And, of course, it's going to be, we can go year by year by year. But you're getting the picture that we're painting is that the more premium deposits that we're putting in, year number 2, we put in another $12K. However you pay it, $1,000 a month, $12,000 one time. We're going to put in some more cash value. That's going to increase our death benefit. All right. It's going to increase our death benefit. And because remember, what do the rich people do? They buy assets and they collateralize them. They borrow against them so they don't have to pay taxes, right? And JK, I do see your question here.
We'll get to it in just one second.
Just one second.
We'll come to it.
So because I have more cash value here, the insurance company's going to say, "Hey, you got more. You have more of a death benefit here. Hey, the asset that you have is worth more. Here's more of that asset that you can collateralize. Here's more cash value that you can use right now." And remember, why are we borrowing against the death benefit is because it's an asset, for one, and for two, we're not dead. We're alive. So we need cash value. We need the value of this death benefit that we can spend right now while we're alive. And I always thought that this was amazing too, because when I was coming into infinite banking, I did not fully understand it. I read my contract, all of that. I still did not
Well,
fully
it's
understand.
infinite. I'm not saying that I fully understand it. I've been
But
playing the
thing is,
game
though,
for 9
one
years.
thing that you pointed out to me, and I was on lives with you, and you were like, you did this, you did exactly like this. You was like, the death benefit is going up, the cash value has to rise to meet the death benefit.
Mm-hmm.
It was literally not until you did that with your hands, with the cups, I was like, oh my gosh. So if I have a $500,000 death benefit, that means literally my cash value has to grow to reach $500,000 that I can spend. Now I may or may not live long enough to actually spend it all.
Sure, but we gonna try.
Exactly.
If I'm alive, I'm gonna try to spend it too.
Eat your green beans. Eat your green beans. Stay alive long
Canned
as possible,
goods,
right?
ladies and gentlemen.
Cool. So we know over time, as this is increasing, we can pay off more and more of this car note. And what does that mean? We can pay it off even faster. That's why inside the video, we have a video of how someone bought 3 different vehicles, got the money back from these vehicles, and also too, they got. We have another debt example where somebody got out of a lot of. I know the numbers ended up changing. I don't want to say I'm wrong.
We're now showing very soon a new presentation where the debt amount is about $430,000 of debt.
$430,000.
And we're going to get out of that debt by utilizing cash value
Exactly.
numbers.
Now, Brent Kessler, real person.
We'll pause on that. Let me get over here to JK.
Go ahead, JK.
JK, what's up? Appreciate you guys out there. If you're not following us here on TikTok, appreciate that you are. We're talking to some YouTube folks as well. How does one figure out the MEC line to a policy? Does a formula exist besides asking your agent or insurer? The short answer is no, you don't figure it out.
Oh, yeah, you don't want
Once your policy is in force, you can see the MEC line day 1, year 1 in the paperwork. They'll show it to you that day. But the MEC line, for those of you who are educated and understand, the amount of money that you're allowed to dump into the premium deposit at its max at any given time as you continue to live, the policy continues to grow, is a moving target. JK, you out there? You with me? It's a moving target. And you're getting older, and that moving target window is 7 years.
And who's coming up with this moving number?
The IRS made it up. So the insurance company's got to make sure that their policy for you to not be taxed as an investment or a modified endowment contract has to make sure that you don't go over and eclipse that amount and put too much money in. There's no humanly possible way to figure that out.
So what I tell people is, what is the IRS job? How does the government make money? Take your money, right? So think about it. It's not for you to calculate. We don't want to guess that. We don't even want to take the risk of it. That's, what's the whole point of infinite banking and what we're trying to do? We want guarantees. So if I want to guarantee that I know my number, I don't need to be trying to sit down and do some math. That's not what I want to do. I want to call the insurance company, or we can help you get that number as well. And I want to know exactly what it is so that I don't have to guess. I don't have to worry. I don't have to stress. I know exactly how much it is until I meet that MEC limit, and I just don't exceed it. Now, one thing I was going to say before I left off is with the debt example, Brent Kessler in real life, a real life person, I interviewed him. You know him. We all know him. And he was saying he got out of like close to $1 million in debt using his infinite banking system. So even the example that we have inside the video, that's half of what he actually realistically was able to get out of. And I was wondering, did I have that wrong?
Well, we got it in 2 different directions right here. On YouTube, it has to be one way. I think it's now right for YouTube left or right, but it's backward on TikTok. So, JK, did we help you understand that? The MEC line is something we were all of us are going to check in with the insurance company on. I do it. Does that apply annually? Yes, and monthly. So in our favorite company, they'll give you the number that can go into your policy without mecking each and every month within a year. So like I said, it's impossible to figure out. And I don't know where people look online or in books to get so nervous about it. If we check the box, quite literally, when we started your policy, which we'll do, of course, to tell the insurance company, we're not trying to create a MEC or a modified endowment contract. If and when you put too many dollars into this policy, they will send you a letter in the mail, they will send us a letter, so you don't have to worry about it. But it is a relevant concern but the insurance company has fail safes in place where we don't worry about it, and it's an impossible tracking mechanism. As soon as you put dollars in above and beyond what's required into your policy to grow it more efficiently for cash, a new amount went in on a 7-year rolling window for the rest of your life. We can't track it. Impossible.
You know what's crazy about this is that I actually just received this in the mail today. Mackenzie was reading out to me as we were riding up the street coming here, and it said, "Hey, Robert Lee," it gave me my policy number and whatever, and it said, "You put in too much money
Okay.
into paid up additions." So I completely maxed that policy out. I can't put in any more.
Right now.
Rolling,
remember, it's rolling deal.
They said, "Hey, because your policy renews in June,
annual anniversary.
That's when you can put in more paid up additions." And I was like, "Oh, okay, cool. Don't put in any more." Here's the thing: they're going to write me a check for the money that I put in.
They're going to send it back,
and that's what I'm gonna do. I'm gonna take it. I'm gonna try to put it inside of another policy, and they don't take it in that one. I'm trying to put it in my other policy. But
get new policies when you max them out.
And this is why you'll hear us talk about how we have more than one policy, because you're gonna run into depending on how efficiently you're using it, you're gonna run into a problem where if you're really doing banking like we were talking about, you're going to need some more space, and you don't want to have to keep running to those mechs. So just get you more policies. You got kids. Jeremiah here, he's good at making them. He's got 4 of them. Yeah, so he's got plenty of policies.
They're cute though. We got content with them. They work here,
they're employees.
They're itty bitty bros.
Yeah, I got a son on the way. Hopefully, he might even get to slide into the.
Of course he will.
Okay, good.
Of course he will. We're gonna put him to work. All right.
Yeah. Okay.
Okay, Richard. Appreciate you out here. One more question from Richard on our TikTok channel, The Cash Compound. Go there. Can you throw a bit of light on how to access your IUL fund?
Oh gosh.
Here we go, Richard. First off, we're talking about whole life insurance here, so we want you to know that. Appreciate you being here. And IULs do have cash value or surrender value accounts, and we're not going to use them around here because we found a tool that's 150 years older. That's guaranteed to grow in cash flow. Your IUL is not guaranteed to grow in cash flow for the rest of your whole life. The premiums are going to go up over time because the cost of insurance rises. Okay, so your premiums don't actually have to go up, but the cost of insurance rises, so it's buying less and less or securing less and less guaranteed benefit as you age and as you get older. Therefore, we're not exactly sure if we're going to have this cash flow. Second reason we're not sure if we're going to have that cash flow, Richard, is because these dollars are a reflection of the call options in the market strategy the insurance company employs with us. It is not guaranteed to do anything. So
correct.
Just making sure you understand that, my friend. Yeah. Reach out to us by clicking that link in the bio for a cash consultation if you want to talk about it.
Really simple. I always tell people when it comes to indexed universal life and why we don't use it is because, think about it, indexed universal life is tied to a market. That's no different. It's like a fancy version of a 401k. If we wanted to invest with this, then we would just do our own. We can always take cash value out and do our own investing. We want guarantees, and we want to know that whatever I choose to pay is going to always be the same. I'm not in it to ride the waves of my wealth. 20 years from now, 30 years from now, 40 years from now, we know what we can expect, and it's going to look like that or better depending on how we use our system. JK,
hold on. Richard, real quick, has a follow-up. Does whole life grow cash value? Guaranteed, my friend.
Absolutely.
Guaranteed, my friend.
That's the big difference, is that you're signing a contract that says, hey, you have to take all my small amount of money and turn it into a large amount of money guaranteed. When you sign up for an index universal life policy, I want you to understand what you are doing is you're saying, hey, instead of you having to take my small amount of money and turn it into a larger amount of money, technically, you don't really have to do that. I'm willing to take the rides in the market to see whether or not I can get a larger gain or whatever the case is. But that's, think about savings versus investing. It's a completely different term and completely different word for a reason. We want guarantees. And as long as we know our money's growing guaranteed, I'm a trader. I'm in the cryptocurrency, precious metals, you name it. And I'm telling you, I like volatility. I like risk because I understand that it can help you grow your wealth at an exponential pace. But here's the thing. I need to know for sure my dollars are growing. After that, we can go take on our own risk instead of having the insurance company take the risk for you, which, let's be real, there's going to be fees that's associated with that when you're getting in and out of the market. They have to trade for you. So what do you think they're going to do? Do you think if the market goes down, do you think that the insurance company takes the loss or that affects you? It's going to probably affect you. They're going to
right.
put that risk back on you, the policyholder, and we just don't want that. We want to make our own investments. We want to be better investors. Is what
There we go. I like
term,
the way
better,
you threw that in
we
there.
want to be better investors, man.
All right, JK on YouTube. Appreciate this next line. Question is: so can you backfill for previous policy premiums or paid up additions that you didn't max out? Yes.
Yep.
Yes, you can. Now, you can't do it at every company every year for the rest of your life, so that has to do with company stipulations.
It's a window.
The favorite company that we choose to use and partner with most often allows that backfill to happen like 2 years out. So, yes, you do have options if you did not get the dollars in because money was tight or you had it deployed in other areas. So, great question, JK. We'd love to get you the specifics on that if you don't have
That was
it.
a really great question.
I'm not sure that I've had that question from somebody. And it's the second time today the question has come up because we were entertaining a new person and agent who's looking at joining our team. And he was asking about the differences in companies. Great stuff. JK, hopefully that helped, my brother. Okay.
All right, so we could take the same exact example of what we were talking about before, and we were saying like in the video, we're looking at an individual who's paying off a lot of debt. You could be a real estate investor, whatever the case is, and maybe you got some HELOCs out. Maybe you've been borrowing off of this home equity to get you another rental property, and so on and so forth. And do I need to reshare this or something like that?
No, they can do it from our. There it is.
Good, yeah.
Ryan's got us, and
Mr.
Ryan and Will
Producer.
got us. Yeah.
I appreciate you, man. So with that being said, is now let's say instead of me paying directly towards debt, and it could be credit cards. Let's just say it's debt. Period. It could be credit cards. It could be a number of things all bundled into one. But for an example, you're paying about $12,000 a year in debt. You could put $12,000 a year into the policy, your banking system. Instead of taking that $12,000 and applying it directly towards the debt, what if you took the $12,000, you put it into your banking system, and then you borrowed from your banking system to be able to now put towards the debt? So now I'm going to borrow the $8,000. Oh, still on the eraser there. Hold on 1 second. I'm going to borrow from this $8,000. Oh, this is way better. Well, where was this the whole time? And that's going to go towards my debt. Okay? So now I'm saving. Remember, let me see if I can make this better here. So I'm saving. Oh, I'm getting better. Saving $12,000 while still being able to spend $8,000. And when I spend this $8,000, I'm going to put that towards the debt. And so that's $8,000 less in debt that I had before, but I have $12,000 saved. Why? Come back to the 3-cup setup. When you put money in premium, what does it buy you? A larger sum of money. What do? We borrow from that. If you take a loan, that's no difference than you swiping a credit card or taking a loan from the bank now. When you swipe a credit card at a regular bank that you have, Wells Fargo, whatever the case is, when you swipe your credit card, does it affect your checking or savings account? No. If you take a loan from the bank, does it affect your savings account? No. Here's our master savings account where it grows with interest. We borrow from the death benefit. We can take this money, pay down towards our debts, okay? So with that being said is we're saving and spending at the exact same time, which of course is why we call it the save and spend system, all right? So instead of me paying that directly towards my debts, what if you took the minimum? So if you're somebody out there, okay, no more questions here. If you're somebody out there and you have a lot of credit card debt or whatever the case is, think about what you could be doing. If like I had a gentleman, he was paying $500 a month in just minimum payments towards his credit cards. What he did was he consolidated that $500 into his own banking system. All right. Now he has more debt than that, right? But that was just in credit cards in itself. What are some of the payments that you're making? If you're making small debt payments, maybe you need to add those things up and put them into your banking system and then borrow against the banking system to now pay off the debt. Why? Because let's say, for an example, I have a couple different credit cards here, all right? So I got one credit card that is $2K credit card, okay? I got another credit card here. Appreciate you, Ryan, in there doing your thing, man. Or you or Will, one, okay? $2K on the credit card. I got another $3K on the next credit card, Okay, that's 5, and I have another 3K on another credit card. If I took the 8,000 here and brought it and applied it to these credit cards, I would have paid in full. In full, I would have paid off what? 3,000. I'm sorry, 3 different credit cards. I almost said 3,000. Sorry, I would have paid off $8,000 in debt. Here, 3 different credit cards would be wiped out. I don't have those anymore. So I'm $8,000 less in debt, but I was still able to save $12,000 inside of that year. Now remember, like we were talking about before, what happens every year? Every year, you put in more premium. Okay? What happens when you put in more premium? You get a larger death benefit. Death benefit has to go up. Okay? We're buying more of something. What happens if you take money and you go buy a piece of land, and then you come back and you buy another piece of land, and then you go to the bank and you say, the bank is going to say, hey man, first time you came in here, you had one acre. Now you got 2 acres. What is the bank going to do? If you want to loan money from the bank, what are they going to say? Oh, well, we'll let you get some more money. We'll give you more than what we were going to give you the first time. Why? Because you have more land. You have more of that asset. Here, we are the asset. That's why we are the bank. So, more the premium goes in. I have a larger death benefit. Insurance company say, hey, this number went up. So, what has to rise with that? Cash value. Here's more that you can spend. Right? So what happens is inside of the next years and the following years past that, I'm going to have even more money that I can use and spend to pay down towards my debts. But do you see here inside this example why it's not a good idea at all to come from paycheck directly to debt? And we show this inside of our presentation video, the save and spend system. When you go into debt and you use your paycheck to pay that debt off, you go back to zero, or you go back to where you were. Here, we did not go back to zero. We stayed at $12,000 in savings, used the $8,000, paid off 3 different. What kind of chips you eating?
Cheetos. That's some Cheetos.
You got my stomach growling. Man. we stayed at $12,000 in savings, used $8,000, wiped out 3 different credit cards. One for $2K, one for $3K, another one for $3K. Those are gone. Credit score is going up, all that good stuff. But guess what, though? What's the most important part of this? When we go to pay back, not only were we able to save $12,000 a year, I keep looking at myself, still looking here, and not only were we able to save $12,000 a year, what else were we able to do? We're able to recapture our wealth. If we do pay ourselves back, let's say we put this $8,000. Now that we wipe this debt out, we got our paycheck here. Okay, and we start using that to pay back into our cash value. We'll have $12,000 in savings. Okay, I try to break it down to people like this. You got a savings account, you got a checking account, right? We want to save and not touch our money in our savings. That's the whole point of savings. It grows, safe, and it stays there. Right. Continues to go up.
Mm-hmm.
That's not actually happening inside the real bank because we don't really have any growth. And, I mean, let's be honest, the banks aren't really that safe. If you're paying attention to what's going on, we just had 2 more major bank fails, okay? But that's neither here nor there. Moving forward, I got my savings account here, checking account, a.k.a. cash value, what I'm looking to spend, do my transactions with, right? I'm going to pay back my $8,000. Now, mathematically, if you had $12,000 in a regular savings account, and $8,000 inside of a checking account, how much do you have total?
20.
Exactly. But here's what our brain does. It tricks us. It says, if I put in 12 and I take out 8, I only got 4.
Mm-hmm. It does trick us.
It tricks us. But did it come from the same account?
It didn't.
No.
Checking and savings.
Checking and savings is completely different.
Love it.
All right, man. That's my little exercise, man.
All right, you guys out there on TikTok, hopefully you enjoyed that. And if so, let us know by giving a like, love, or a heart right here. Double tap on the screen and follow along with what we're doing at the Cash Compound by clicking that button. Follow and go to our regular page. We've got a link in the bio, and that link will help you get a free one-on-one consultation with one of our coaches. We've got one of our newest recruits out there. I shouldn't say that. People get too excited. But Elizabeth, Yo, good to see you. Look forward to getting you trained up in a great cash conversation just like this one as well. Appreciate to our YouTube family out there, out on the subscriptions of YouTube. Oh, we got another question. So what is the interest rate guaranteed for the policies you use? Great question here, JK. Okay, so JK knows some things. You give me some feedback first, JK, and I'll answer that one. Do you already have an infinite banking policy? Let me know what your status is. How long you've been tracking us? Are you already utilizing? The way you asked that, I'm assuming you're not utilizing us as your coaches yet or at this point, or you've got policies elsewhere. We love that, but let us know.
Let's see what he said.
I'll wait just 1 second, just to make sure, just to make you wait on it, on this answer. But the policies that we utilize are slightly different in a range of guaranteed numbers. This is sans dividends. Remember, dividends are coming extra or different, but you're not going to get very much difference here. JK, whatever you think it is the right answer. You would only ask that question if you already know. There's not a better one out there based on some sort of interest rate.
He says no.
Okay, so you don't already have one. You're not utilizing us, I think was my question.
Yeah.
Okay.
The four.
Because I asked like 50 questions. I keep talking, so I'm always asking like 50 questions. Like, which question is the answer?
It made me think about the presentation video. And JK, if you haven't already saw it, what do we show inside the video? Can you earn at 4% and borrow at 6%?
So we don't tell you exactly, but we actually insinuate in a couple of places that you may not, even if you've seen it, you may not realize. 4, okay, is what we're basically showing, which is probably a little lower than what's happening over the course of your life based on guarantees and dividends. But the guarantees based on the major insurance companies that are going to allow the flexibility of cash value right away for infinite banking style policies is going to be between 2 and 4%. Our favorite company we utilize most often here, we are brokers. We'll utilize different companies depending on who you are and what you need, what state you live in, how old you are, whether or not you're 26, 30, 36, 24, 36. If you understand that joke, throw it in the chat. Okay, Robert knows.
Yeah.
Is between 2 guaranteed and 4. Our favorite company is 3 1/4. Okay, so 3 1/4 on their traditional whole life policies that are good for infinite banking. Dividends make it beyond 4. So,
and keep in mind too, it's just like any other business. Insurance companies have to compete with each other, right? So it's just like any other market.
But they're not. But they're competing in several different ways. Exactly. It's not the guaranteed rate. Remember, this is not an interest. This is not an interest game only. This is a mortality game. This is how much this costs. This is administrative charges. This is also the growth is going to be based on what the general portfolio does, things like that. All right. Does that make sense out there? So Elizabeth out there, she just got herself a policy about a month ago. First policy, congratulations. The guaranteed rate on that is 3 1/4 is what this is growing at after the charges for the insurance. So when you first put dollars in, it buys all of this and there's some of it available. That is going to grow at a guaranteed rate of 3 1/4. Dividends make it more than that. But remember, this number is a guaranteed number. Sans, commissions, fees, taxes, tsunamis, Elon Musk tweets. These dollars are going to pay out, and it's liquid cash. It's not an average. This is not some sort of investment. These dollars can now be invested. You're still going to get what we call constant compounding on the dollars you've put in. Sometimes people get that confused with their investment terminology and jargons.
Rate of return.
Yeah. Be careful with that. Okay. All right. Elizabeth is starting to pick up on it. The more you learn, the more you realize you need to earn to put inside here, right?
Correct.
I'm not going to call Elizabeth out for her teeny tiny baby policy because I'd have to call out Robert for his teeny tiny baby policy when he first started.
I was about to say, I know you're going to call me, so don't do it.
When I got started, I started with the best policy that I could do in terms of premium. I didn't even take income. So I cashed out a qualified plan. I cashed out a qualified plan because I didn't have the income, but it was 10 grand per year, and I thought that was the most baby.
Time to get the
And
next year's payment.
and I assumed that was the most baby policy. Correct. That was another thing. I need to save up 10 grand, 5 figures.
I was sweating on the phone with Brent. I'm like, can I please?
Yeah, the smallest policy that I thought I would possibly do without getting laughed out of the room was 10,000. And we've had a lot of people start with different numbers than that, but we're generally trying to help people understand that if you can save money, this is the place to do it. You might want to think about $1,000 or so a month, 12 grand per year. All right. I need another. I'll sell it to me. You'll need another.
She said I need another policy, and
you'll sell it to
and that's the thing. I think we all realize the same thing. Once you understand that it is a banking system, and you put money in, you take money out. You put money in, you take money out, and you need to use the system. The thing that I've come across the most. Every time I talk to someone who hasn't like fully immersed themselves, read the Become Your Own Banker book, actually watched our presentation video or whatever. Now, I'm nice enough. I'll give you a 15-minute conversation if you haven't watched the video. Jeremiah, don't get on the phone with this man.
No, nonsense.
You want to give him 5 minutes?
I'm going to give him some time. I think Jonah is the one we need to worry about. I'll give him some time.
He's finally getting a little taste of that medicine. I love the fact that
My brother Jonah, the other banking bro in our office here, he takes a lot of calls. He doesn't go live very often. And sometimes when we're not doing battle with our friends on the phones, right? We're not doing battle with and trying to answer everyone's question and helping them from wherever standpoint they are. Sometimes we forget that everybody's starting from different starting lines. So these we have debates on how do we standardize what we say? How do we help people? What's a best practice? That's what we're talking about.
But you have to use it though. If you're not utilizing the policy, it's not going to. For one, it's not going to make sense. And because your traditional way of banking is money goes in, you stays there, and you utilize it. The difference is our money's going to go in. It actually is going to stay there, but we can still collateralize our death benefit and save and spend at the same time. So
put your dollars to work, and your dollars buy a separate pool of dollars that you can invest, spend.
You need to use the policy for a number of different reasons. You can recapture your wealth. You can control your financial environment, so on and so forth. But mainly is because it in essence, it is a banking system. You need to utilize the policy. And when you do that, you're going to see, oh, my life's getting better. Oh, I got out of debt. Oh, I pay down that car faster. Oh, this thing is working. I have more income. Maybe I need to put some more in here. Like if you see something working, right, and you go and if you water a tree consistently, it's probably going to outperform and grow bigger and stronger and produce more fruits or whatever than a tree that you go out there and once a week or whatever. And so that's all we're doing. We're just adding a little bit more water. We're saying, hey man, instead of I was only watering this tree, once a week. I had one policy, whatever, right? Let me go get some more policies. Let me protect the loved ones in my life. It's still insurance at the end of the day. So JK, besides the regular info, what is needed to take a policy out on an
Ryan, can you help us out? We can't see how old
he's saying
that person is. My guess is it's behind the heart. We can't. 1-year-old. Nope, it's a 1-year-old, a baby.
Oh, 1-year-old,
okay.
1-year-old.
So, good news. I've taken policies out on 1-year-olds. Okay, and we have a great visual for that. We won't bring it up here. We're wrapping up our hour here this afternoon. Okay. What info is needed to take out a policy on a 1-year-old? Nothing needed extra than what we've said. When it comes down to it, you'd still be submitting premium, asking for a policy, and is the insurance company willing to cover that child for that number? The death benefit is the number they have to pay. The premium is the number you tried to put in, you want to be consistent with, and we're going to build a policy that has cash value to collateralize on it right away.
Okay, JK, you definitely want to get on you need to get a cash consultation, cash call. Jeremiah got us 1,000 ways of saying that. I like them all. But you need to get on our schedule because you're saying you want to put it on your nephew. It's going to work a little bit different. That's not your child. Okay?
Unless, you may not have, you may or may not have insurable interest on your nephew, depending on several factors, including whether or not this kid lives with you, for instance.
Yeah, I'll put it on everybody.
We'll get you started on that. Totally fine. So last year and sometimes on these AMAs, I use examples of what we call father figures, how to put policies on kids. We just call it that because several of us are dads. dads around here, and several of us are moms too, and we have children. Several of our coaches, but several of us are dads, so father figures. And I started a policy that I consistently show to people in examples that was started on a 3-month-old. Totally fine. So we're going to build it the way we're suggesting for cash value. You don't have to do anything, know anything extra, but there are slightly different entryways that we've got to make sure we do what the insurance company wants and needs when we're putting them on children. So we'll help you on that with a cash consultation call. All right, ladies and gentlemen, we're going to call it for this afternoon. Appreciate you. Remember that we go live Thursday afternoons, 3:30 p.m. Next week, we're kind of in a bubble. There's a little bit different of a schedule, but normally 3:30 Eastern time is when you can find us on these lives on TikTok, Instagram, YouTube, Facebook. Go ahead and click our link in bio, subscribe, like, heart, and get that cash consultation. We'll see you. Peace.
If I learn how to work this, anybody.